There are incredible tax benefits that you can receive from converting your flared, stranded, or undervalued gas into Bitcoin. And today, our guest is Jordan Guest from Bitment. Bitment software is a one-of-a-kind tool that allows you to put your Bitcoin into your bookkeeping. This is going to save you a lot of time on tax time, on your day-to-day accountant, and it's going to get your bookkeeper up to speed as you enter into Bitcoin and the Bitcoin mining business. Flare to Fortune is brought to you by Blue Hawk Energy Solutions. My name is John Taylor from Blue Hawk, and we're here on the OGGN, the Oil and Gas Global Network, to talk about how oil and gas operators are converting that flared, stranded, and underused gas into Bitcoin. Let's get started. Jordan, thank you for joining us today, and I'm looking forward to unwrapping more about taxes, accounting, the custody, and the financial side of Bitcoin. So thanks for joining us.
Yeah, happy to be here. It's taxes are one of those things that some people glaze over and they fall asleep if they're having to listen to that subject. Other people, as they've, just grown their net worth and their business owner, they're like on the edge of their seats, right? And they're trying to think, how am I able to minimize my tax bill, obviously in legal ways? And so I'm excited about our conversation because some rules have changed this year that particularly affect the industry that I know that you and I are pretty heavily involved in. And there's just great opportunities to deploy some capital, get some tax benefits this year and the years to come after this. And so, I've been looking forward to this conversation all week.
And there could be a better time because this is the time when people start really thinking about their taxes. They're going into Thanksgiving and they're like, I got to start gathering the books, gathering the stuff. The accountants, the bookkeepers are saying, hey, we have to get some tax write-offs. We have to look at things before the end of the year. And one thing that happens when I talk to oil and gas operators, we talk to them all week long at conventions and in our phone calls. They're interested in flare gas mining and converting their wasted gas or undervalued gas into Bitcoin. But what stops them cold is their accountant or their CFO has no idea what Bitcoin is, how to handle Bitcoin on their books, and what's actually happening. I'd like to get your insight of what do you think is actually happening in those conversations between the operators and the CFOs or their CPAs?
Well, I think initially, and we actually just, hosted a Bitcoin for Financial Services Summit about 2 weeks ago. And that whole event was trying to educate CFOs and controllers and financial advisors, tax accountants, that whole group of professionals on what Bitcoin is and why it's different from other cryptocurrencies, how there's, advantages with Bitcoin mining. And to answer your question, there's just a lack of knowledge, lack of education right now. And then if you even get into the weeds, there is someone that is, on the CPA side, for example, that has looked into things, a lot of times they are branding themselves as a crypto CPA. And while it's not always the worst thing in the world, there's a ton of work to be done in that realm too. It can get confusing. And when especially when you're talking about some of these meme tokens that have popped up that just kind of takes away a lot of the credibility that that Bitcoin space, I feel like, has tried very hard to build up. You just get very quick dismissals from the C-suite that have a lot on their plate to begin with. They're managing cash. They're trying to make sure that they're growing the business. They've got pressure from their investors to hit certain, goals and all that kind of stuff. And so you add in this complexity, or at least perceived complexity, in how are we going to treat this? The rules are changing at FASB, and I think a lot of them are just like, I don't have the time. I don't. And sure, it could be interesting, but it's not something I've looked into. And I'm just going to default back to, I've heard it's a scam. I've heard it's used by money launderers, and they just kind of live in that. And so what we're trying to do in a lot of ways is educate those folks. We don't have to do the full, accounting for a client. We can even just have a conversation with them to explain how to treat it on the GL, on the general ledger, and how it affects the tax return, and then let them run with it. But also what we're seeing is a lot of clients are leaving firms that aren't open to the conversation or shut it down immediately. And so, yeah, there's a bit of I guess, musical chairs, right, of moving from one firm to another firm that is more suited to deal with their needs.
And you created a software that addresses the problem of how to, get Bitcoin on your books, how to manage it, maintain it in a way that makes sense for the CPAs and CFOs. And that's why you built Bitment. But before we dive into tax strategy, because we really want to go into that, because I think that's so important, especially this time of year. Explain what Bitment actually does, and specifically how it's different from just using QuickBooks and hoping your accountant figures the whole thing out.
Yeah, that's a good question. So what started me down the path of Bitment was that there was no Bitcoin bank statements. So even if we got everything into QuickBooks correctly in dollar denominated accounts and categorized everything to the correct revenue or expense account, there was no function where I could easily go pull a bank statement from the blockchain and then use that source of truth to reconcile. And all the process of reconciliation really is making sure there's no duplicates in the books, making sure that there's nothing missing. So your beginning balance plus what came in minus what went out equals your ending balance. And so that was like step one was, is there any place beyond just becoming really good at reading the block explorer, mempool.space to reconcile the books? So the first thing it does is you plug in your wallets, which all it is a very similar OAuth experience when you give access through Plaid to view bank transactions. So you give us in Bitcoin, you give us your XPub or you give us your addresses. And that all that does is gives us the ability to view the balances and view the transaction history. You build a banking experience where you can go in, you can see your different wallets, you can click in and see all the transactions. You can filter them by date, by amount, by detail. You can add memos or details into each line. You can do that one by one. You can do it bulk, which is what we normally see people do. All that to say, it gives you that like similar experiences when you log into Chase Bank and you see your accounts and you see all that transaction history. Then you can also export a bank statement and use that as a source of truth, either to reconcile in your books, or you could send it to an auditor, if you needed to get a loan, something like that. Then all of that flows into an accounting software that's built within. So you've got the banking side, you've got the accounting software. You link your Bitcoin wallets to, Bitcoin accounts in the chart of accounts. And you do the same with your regular bank accounts, credit cards. You link those via Plaid. Then the bookkeeper goes through and does their data entry each transaction. They either write a rule that auto categorizes it to a certain expense category, or they just manually go in and categorize those. What's different, and I'm glad you brought up QuickBooks, what's different about our tool versus QuickBooks is that the data entry, you're assigning the general ledger where it goes for the P&L or balance sheet purposes. You're also marking whether it's a cost basis or taxable event trigger. And so then it also flows where it needs to go on the cost basis and tax reporting side of our software. So there's really three pillars. There's the banking, the accounting, and then the tax reporting. At the end of the year, we need the P&L, and then we need the balance sheet, and we need that 8949 that shows all of the sales, the proceeds, and the cost basis to be able to do the tax return for a client like you and I would generally work with.
Yeah. And I'm thinking of like an example, like if an oil and gas operator might have, I don't know, let's say they have 7 or 8 wells and it's producing a megawatt worth of power. That'd be about a Bitcoin per month. So Bitment, how does Bitment track all of that in a way that makes sense during the tax season? And it's simple instead of some nightmare, because I know they're going to be taking Bitcoin out and they're going to be paying bills, and they're going to be taking Bitcoin out and converting it and holding it into treasury. So it seems complicated to a CFO or a CEO who's never handled Bitcoin or installed that treasury into their company.
Yeah, so when the Bitcoin comes in, we recognize that as revenue at the USD value when it came in. And then for any amount of and that sets the cost basis as well. So if you earned one Bitcoin at $100,000, that's $100,000 of revenue, but then that also creates a cost basis, lot line. So one Bitcoin or 100 million Satoshis, and the cost basis for all of those Satoshis is tied to that 100,000 USD value. Then, and you could see a world where, right, you've got a ton of these lines and you're having to track those lots. Then when you go to sell or send some of it either pay expenses in Bitcoin terms or sell it back on an exchange for dollars to then go pay your OPEX, that is when we know the proceeds, and then we tie that back to that specific lot and calculate the gain or loss depending on what cost basis method you're using.
And I think here's where operators get confused. When exactly do you owe the taxes on mined Bitcoin? And when are those taxes due? Is it when the Bitcoin hits their wallet? Is it when they sell it for USD? When they trade it for a different crypto? Can you walk us through exactly the actual tax events that happen when mining Bitcoin?
Yeah, so you recognize it as revenue, then you've got your expenses, and then you are taxed as ordinary income on the net profit, right? And we'll get into a little bit later why in the world we're currently living in, a lot of the income tax side of things is not relevant because of the new depreciation rules that we can take. But if you just take that piece out, you think of it as you're mining Bitcoin, you're paying out maybe a hosted mining fee every month, electricity, maintenance, potentially rent, whatever it might look like for that specific setup. You've got all those deductible expenses going against the gross revenue, and then potentially depreciation or not. But whatever that net number is on the tax return, that's generally subject to ordinary income taxes and as well as self-employment taxes, assuming that we are treating it as an active business, active participation business. Then you also have the tax on the capital gain, right? So that's the whole piece of now you sell it, now potentially went up in value 20% since you mined it. We're going to have to potentially, depending on the cost basis method and the overall picture, have a cap gains that we have to pay additional tax on top of that. And I'll just say, I know that there's a lot of folks in the Bitcoin mining space that are in pretty constant contact with folks in Washington about the fact that we are being singled out right now relative to other, mining activities, be it, if someone extracts, some kind of mineral out of the ground, they're generally not taxed on the USD value as ordinary income. And they're generally only taxed on it when they go to sell it. And so I know, at least with my time in the space, we've been fighting pretty hard to get similar treatment applied to Bitcoin mining. But up to this point it's still where you're taxed when you earn it. So
I want to kind of dive into that a little bit more. So let's say an operator, they have we're just going to use really small numbers. They mine $50,000 worth of Bitcoin. but doesn't sell any of it. They just hold it in cold storage. Do they owe taxes on that 50,000 even though they haven't converted it? And what happens if they mine it for 50,000 in March, but then in December it's worth 30,000 by tax time, let's say? Are they still on the hook for the $50,000 valuation, or how does that work?
Well, yes, they would. So the gross revenue that we put on the tax return is tied to the USD conversion at the time that it was received. So, and you probably maybe heard about this when some of the NFL players started taking some of their salary in Bitcoin back in, I think 21 or 22, where it was like, gaining popularity. Very similar experience for them, where you earned at a certain point that hits your pay stub or that hits the P&L at a certain USD value. And that's what we're going to be taxed on. So to your point, it is very important that you are setting aside, um, probably money in a bit more of a stable short-term asset in order to pay those taxes. Go ahead and pay them in quarterly is what we generally try to have people do. But at the very least, have them in something like a stable coin or a USD, that's earning maybe some yield in a high yield savings account, and then using that to pay the taxes. But again, if you pull in the depreciation, now it's really, we're not worried as much about the taxes because we can see, well, this is what we've invested. We're going to have the 100% bonus depreciation that can be used to offset any of the mining income. And then depending on if we market it as passive activity or active activity, it can be then netted with other income sources on the tax return as well. So to answer your question though, yes, like if you just take the depreciation piece out and you say, and maybe you just go out to years 2 through 5 and you don't add additional rigs to your setup, and you've used that bonus depreciation, now you really are looking at a scenario where you've got income, you've got expenses, but unless you're going and adding more rigs to your setup, you are going to potentially have a net profit show to the bottom line that we need to pay income taxes on and Social Security Medicare taxes on.
We need to explore that more to see how we can set up an operation and then have a defined strategy for upgrading the machines to offset the taxes and what that would look like. And that's where I really want to jump into the tax super weapon, which is Section 179. We've heard a lot about it, and people get the basic concept of it. And it's one of the most powerful reasons operators should be paying attention to Bitcoin mining. So explain Section 179. I'm an oil and gas operator who's heard the term, and I know I can write some equipment off, but really unpack it for us so that we really understand what that means to our operation.
Yeah. So Section 179, it allows the immediate expensing of qualified business equipment in the year that you place it into service. Now, the big thing that is relevant is it's up to an annual limit. And so that's where I do see some people get caught up. They're like, oh, well, I can just expense as much as I put in. And, depending on the level of investment, that is true. So for 2025, it's a little bit more than $1.2 million. And so for people in our line of work, that includes, the actual ASICs that they're putting into service, the containers, and then any kind of generators that they are placing into service to potentially, convert that flare gas into electricity and plug it into a Bitcoin mining miner. So that's the main piece of the Section 179. It's pooling those expenses that, in a lot of cases, you potentially have to spread that out over multiple years in chunks as deductions against your income. This allows us to pull it forward into the future, take it in current year expensing.
Is that only for 2025, or can we do that in 2026 also?
Yes, no, this goes out. This goes out for the next 5 years.
Okay. So if I'm A strategy would be if I'm putting in a megawatt, I would want to buy $1.2 million worth of ASICs and then maybe lease the generator. That would be a really strong tax strategy for this process.
Yeah. Yeah. I mean, all of this, I would say, and I'm sure we'll put there's either already been a disclaimer read or we will have one, but it is all very particular. And I'm loving the conversation of like from a high level, get, get people thinking through, here's some different things that I should consider. But, these decisions are made, in an engagement with a qualified CPA and looking at the full picture, and making sure that we hit certain thresholds on time logs so that it's actually in the active income activity bucket. So all that to say, these are like big ideas, but there's probably a lot of work for you and I to be doing over the course of the next couple months to actually implement some of this before we hit year end, right? And do that on a one-on-one basis with business owners. So
Yeah. Let's make a scenario, and let's say an operator invests $1 million into in mining containers and ASICs to monetize their flare gas at a site. So, walk us through exactly how Section 179 changes their tax picture in year one. And let's say we start this in 2026 because we're at the end of this year. What can they deduct when, and what's the actual cash benefit? What can I say? You're going to make a Bitcoin a month, which equals a Bitcoin a month, 12 Bitcoin in a year. But what would the tax cash benefit be?
well, and then I guess one quick question to follow up. What's the timing? Are we talking about someone that's going to make this investment in the month of November and go ahead and place everything in service prior to 12/31? Or is this someone that maybe made that investment earlier in the year and they were earning 1 Bitcoin a month starting in March or April, something like that?
Yeah, starting in March or April, realistically, a lot of these setups that we're doing right now, they're going to be energized in March and April.
And March and April of 25, right? Or of next year?
26.
Oh, okay,
Yeah.
of 26. So yeah, so anything like that, and the only reason I ask, right, is like, well, if we put $1 million in November, we get everything up and running, but we only have, a month of Bitcoin earnings. Now we're going to have quite the loss, right? And that's the big piece of, well, if it's an active loss, now it gets very interesting for a high net worth or I'm sorry, a high income, I guess also probably a high net worth individual who can use that active loss to offset potentially a high W-2 income. But the scenario that you're discussing is, okay, we do it in, first or second quarter, and we've got plenty of time to still actually earn a lot of revenue. Now you're thinking, my thought goes more so, well, we potentially are in a smaller loss, but that's because we earned a lot more revenue throughout the year. And so maybe we bring in $1 million worth of Bitcoin in revenue. And then, of course, we have our expenses, like our normal operating expenses to run that. And then the depreciation comes in as an additional deduction to, if you're starting March or April and you are trying to earn about a Bitcoin a month, and we spent about $1 million to get it all set up, we should be seeing some kind of loss at the year end for that.
I love this example. It shows the advantage of mining versus buying Bitcoin.
Yeah.
There's like the gap widens because that's one of the first questions that I get, especially in shareholders. They're like, "Well, why don't we just buy a bunch of Bitcoin?"
Yeah.
And to break all these different tax strategies down um, really makes a big difference. So, what if that same operator, instead of taking that $1 million in mining, they just bought Bitcoin directly? They don't get a Section 179 or any type of tax benefit. Correct? Is that correct?
Right. Yep. That's exactly right. And there's generally, depending on your cost of electricity, there's an arbitrage opportunity on what you're actually paying to mine that Bitcoin, right? And that's where I think that's where it gets very interesting, because there's one piece, for how we report things on the tax return, but the how you actually calculate the cost of production of that Bitcoin that you mined, and you take the cost of the machines over the estimated life of those, as well as your electricity costs, and you get an actual price that you had to pay per unit of Bitcoin that you're mining. And then you measure that against the fair market value when you received it. And there's some arbitrage opportunities there, where I've seen people who are able to mine a Bitcoin at an average cost of, $85,000 to $90,000 per coin, even though the price was trading at, 105, something in that range. So, and of course, that is all dependent upon hash rate and your cost of electricity, but the opportunity is there to create that arbitrage. Even if you strictly just wanted to mine it at a cost of production lower than the fair market value, and then just sell off every single time you earn, just to create that net margin. So that's another thing that I always try to bring up to people, and say, again, the devil's in the details, as with anything, but there is the opportunity, depending on where you're getting your power source from, to lock in that arbitrage.
And that's so important with flare gas, because our operators are mining Bitcoin for less than $60,000 right now with flare gas.
Yeah.
And the margin is much wider than people who are paying electrical costs on the grid.
Yeah. That's a great point.
So
I'm sure you're staying pretty busy, John, with with a lot of these conversations, right? Get Bitcoin at sometimes like close to a 50% discount. That's awesome.
yeah, and the operators, they're seeing the benefit. It's just the getting over the hump of, should we buy Bitcoin or mine Bitcoin, and how can our CPA, our CFO, understand Bitcoin so that it can be integrated. And like you said in the beginning, CEOs and people who are operating these big companies are busy, and going through an extensive education program is not on their list of things to do, especially with the end of the year.
Yeah.
Right now, oil and gas operators are facing a challenge of prices are coming in lower than expected. The operating costs are continually rising, and really the utility companies are the ones making the money off of the gas, while the gas prices are staying the same. They've been $3.50 since the 80s, and they go up. They have these peaks and spikes, but I looked at gas prices in 2012, 1985, and today, and it's all $3.50. And that's not adjusted for inflation. That's the price that they're getting. And meanwhile, the utility companies, their income is rising, and they're on a different trajectory than the oil companies. And this gives them a level playing field where they can get the $14 per MCF like the utility companies are.
Hmm.
But let's jump into high net worth professionals. So doctors, lawyers, business owners, let's say they're clearing $800,000. And should I invest in Bitcoin is one of the questions that we get. And how does this compare to traditional tax strategies like real estate depreciation or oil and gas partnerships? What would you tell them?
Well, I see a lot of those types of folks come through referrals from the hosted mining companies. So they would reach out, and get exposure that way. I know that you work with a lot of these folks as well, but it's generally, setting them up where they deploy some amount of capital. We do a tax estimate for them to show, you know, we deploy this amount depending on when it gets placed into service in the year. This is the estimated income. Here's your estimated expenses. And here is, based on all these assumptions, here's our estimated net loss that's going to hit the tax return. And so then we take that, we apply it to whatever their top marginal tax rate is, because generally these are flowing through to their personal tax return, be it on a Schedule C or coming in on a K1. And then what it really comes down to is ensuring that we have the sufficient, paperwork and time logs to justify having that activity be treated as an active business. And that's very important because if it falls within the passive activity, framework, now it can only be netted with passive income, some kind of investment income, which, it's sometimes, come across someone who they make their money trading stocks or whatever, and they do have a lot of passive income that we can offset that. But generally, it's more so like what you describe, an active income through, being a dentist, a doctor. And so we walk them through the process of how to make sure that they hit the 100 hours to justify the active participation in the business. And then we also get them set up on all the tracking, because again, those professionals generally, not to throw shade at any profession, but generally doctors are not, their brain is set a different way versus the finance and accounting tax guys. So, which is great. Everyone needs to be in their role for sure. But we help them also get set up generally on Bitment, get them linked up with their pool XPub, get that linked, get their whatever their cold storage that is receiving all the Bitcoin, get that linked. And then generally they have a bank account and a credit card that we also link up. And the whole point of this whole thing is take away any kind of complexity for either them or as well as their eventual CPA. And so again, like we end up working with a lot of them through the tax firm, and then it's you get all of it in one kind of bundle. But then there's also a lot of people who are like, oh, I've worked with my guy or gal for a long time and I'd love to stay with them, but they have no idea what's going on with anything to do with Bitcoin. So can you make sure that they have the reports clean and reconciled that they need in order to file the taxes?
That is a great insight. So I have my last question, and we're going to go practical. And operators, mining operations, they're mining maybe in a couple different states. They're generating Bitcoin daily. They're paying their costs, maintaining equipment, selling Bitcoin to cover expenses. They're also holding Bitcoin in cold storage for the future. So what does good accounting hygiene look like for that operation on a monthly basis? And what should they be tracking? And how does Bitment, your software, make that manageable for their operation?
Yeah. It's a great question. And especially if you get out of the world of hosted mining, right? And you are maybe going in with a group of investors and you all own the site and you own the containers and you have to pay repair people, all that kind of stuff. It gets a bit more complicated. And I would say you really ought to make sure that you've got all your ducks in a row in terms of how you're tracking everything. So, generally what we would say is hire a qualified bookkeeper to go in and on a monthly basis, track all those transactions, reconcile them. And then if there are multiple sites, be tagging that revenue and those expenses per site so that you can pull a P&L that is, you can show it by location or by class code, however you would like to do that. And that's important for the taxes because you end up having to, depending on the state, like if it's in Texas, we have to do a franchise and excise tax return at year end. And we also have to generally report to the county clerk or the county tax office for the personal property tax. And that could be different by, depending on the jurisdiction that it's in. So, and then of course you have your general, like you have your federal income tax return that needs to be filed, whether again, it's just simple on a Schedule C on a personal return, or it's a partnership return that needs to send out K1s to the partners. So all of that to say, I generally, like a lot of things with accounting and tax, smart people generally know where their limitations are. The same way I'm not going to try to change out, breaker in my breaker box at home. And so try to find a qualified individual or group that can help you with all of that. and get it set up where it's automated and it is painless. And then, we can jump in on whatever part of that journey that you want us. Like I said, some people have us just do the bookkeeping and reconciliations. We pass the tax, docs off to another firm. Other people have us do the full picture for them. So,
I have a kind of a question that's going to relate to what we're doing, because we are setting up our own Bitcoin mining operations in Michigan and in Oklahoma. And so we are, Blue Hawk, along with a couple of our partners, are going to be mining Bitcoin and receiving Bitcoin. We want to put those into self-directed IRAs.
yeah.
Can an operator put their mining operation inside of an IRA structure to generate a tax-free Bitcoin accumulation? And what are the rules, and is it worth the complexity?
My understanding is it is possible, but it is a little bit of a Wild West. It's in the same way that you can use a self-directed IRA to put money into a venture firm, right? And then that venture firm goes and allocates that money to startups, but it's all a bunch of reporting, right? Of like, hey, this is the value that I placed in it. Of course, even with the venture firm example, it could go to zero pretty easily. And so to answer your question, we've been exploring who to partner with on that. I don't have a great answer as to who would be the correct entity to structure that transaction. But based on our research, because we do get this question quite a bit, it is certainly possible. And for Bitcoin mining, it is just, it's very similar to trying to place like a real estate portfolio inside of a self-directed IRA. And so, but then I think to your last question on the complexity, there is always this trade-off. And we run across this with clients a lot where, especially if they're a little bit older, right? And they're just like, hey, have my nest egg. Yes, we could jump through a lot of hoops. And I understand that there is this opportunity for us to structure this where it's extremely tax efficient, but then weighing the risks of, having to potentially go through an audit because it was just flagged, even if we didn't do anything wrong, just that having to interact with them and do all that kind of stuff. Sometimes that turns people off, but then we have plenty of clients that are like, oh no, we're going to take the aggressive stance. Let's do it. I see the return on investment to pay for the service, and we're going to get this extremely large tax benefit. And then if we need to fight it down the road, we're happy to do that. So
I think that's great advice. Jordan, thank you so much for joining us today and giving us all this insight. I mean, I think this is the third leg of the value of Bitcoin mining, and it's often overlooked. Even when I talk to oil and gas operators and I say, but there's this huge tax benefit, they go, yeah, well, and I don't think they understand just how big the tax benefit is. So I really appreciate you giving us so much information and shining so much light on how important and essential this is for the Bitcoin mining operations, especially these oil and gas operators who are looking to increase their margins in an ever tightening, difficult time for them to operate in the United States. So thank you very much.
yeah, absolutely, John. Always great to talk to you. Thanks for having me on.
One thing I really enjoyed about Jordan's interview is that he breaks it down step by step on what tax benefits that you have, how to implement those tax benefits, and different opportunities and strategies that you can look for when you're going into this Bitcoin mining business from your flared and stranded gas. It's an often overlooked part of the economic strategy of Bitcoin mining. People look at the bottom line. How much can I get for my gas? How much per MCF? What does that convert to? And the tax opportunity, which is so great, is often overlooked or underappreciated. So this is a great way to shed light on such an important part of the Bitcoin mining experience from flared, stranded, or undervalued gas. Join us each week on the Oil and Gas Global Network, where we bring you the latest innovations, technology, and information on turning your flared, stranded, or undervalued gas into Bitcoin. We'll see you next week.